As we talk about all of the cross currents happening right now, we do see it playing out with a volatile trade in stocks lower than the record highs. What does the price action tell you about what this does for the overall bull trend we've seen, arguably since the depths of the financial crisis back in 2009?
Great question, Dom. And we think that the secular bull market is still intact at this point in time. But as we lay out the outlook for 2019, we think that we're going to be really corralling this bull market in a trading range of about 2,500 on the lower end, 2,900 on the upper end. And for a year-end objective, we're thinking about 2725. And Dom, as we paint by the numbers looking at this market, we can see right now we're getting substantially more 26-week new lows on the market than we are getting new highs at this point in time. We're continuing to see that there's a very low percentage of stocks still above their 200-day moving average. And when we get these kind of low numbers, Dom, we usually get to a final flush. And from our perspective, we think we're going to get a final flush in this market. It's going to take the S&P down to about 2,500, 2,580. I think at that point in time, we're technically going to be very washed out, reconfirming support, and setting ourselves up for an intermediate-term move. But right now, Dom, it's going to be a little bit more to the downside. So I've been saying to people, we want to be selling the rips and buying the quality on the dips. And right now, I think we got a little bit more downside.
All right, so let's talk about that flush. I mean, obviously, it's very hard to say that as a specific time that kind of a flush is going to happen. But this kind of move that we've seen with support downside that we've had so far, is it at least foreseeable perhaps in the next 2 to 3 weeks? This is a seasonably strong time for the markets. Would we expect to see that kind of a flush in just the final 2 to 3 weeks of the trading year?
I think, Dom, right now we're getting a lot of unwinding of a lot of books at this point in time. It was a very challenging October, November, and also December. And when we've seen, looking back through history, that when you get off to a weak start in December, typically, on average, you're down almost 3% in December when we have these kind of weak starts to the month. So from our perspective, we think it's a couple weeks, maybe a month away before you kind of reach that, in our opinion, tradable low. And then the big question, Dom, is what is going to be the new leadership and on this particular bounce? And what I find interesting right now is not only has utilities and the traditional staples been really seeing 26-week relative strength new highs, we're starting to see names in healthcare starting to put up strong 26-week relative strength new highs. So that's going to be an area I think investors are going to want to be focusing on.
So as we take a look at the, I mean, you watch the charts every single day. Besides, I mean, utilities, yes, consumer staples, they now trade at premium valuations to the overall market. Healthcare is one of those attractive parts. The damage has also been done in energy. Is there anything that you can tell us about what you think about that energy sector or oil stocks in general? Are they nearing levels where perhaps some value investors could consider them a buy as well?
Dom, I think the answer to that is absolutely yes, because when I go through and look at all of our relative strength work, I'm starting to see the energy sector just going sideways. It's not making new lows like we've seen before. I'd also just note, when you look at the commodity compared to the energy names themselves, not only did we not see the energy names participate when oil was rising, they're not falling to the same degree as oil prices have declined. So it feels like a lot of bad news is in. And when you go back and you look at a lot of stocks in the energy space, outside of the services companies, but the E&P companies specifically, they're just consolidating sideways. And in terms of the integrated majors, Chevron, Exxon, they're also just consolidating sideways despite the weaker oil prices, suggesting to us that a lot of bad news may be priced into those names.